Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, June 21st. Last week, and really the last couple of weeks, we focused on the extreme dispersion between equal-weighted S&P 500 versus cap-weighted S&P 500. We all know that the cap-weighted index has dominated equal-weighted. It got to the point on last week's chart that we're pushing up against levels that have historically spurred a little bit of reversion to the mean. And when I say that, the cap-weighted index was up about 13% versus the equal-weighted index over the last 6 months. And that's been an area that's triggered some demand coming back into the equal-weighted area. Why do I mention that? Equal-weighted hung in there a little better this week. Remember, in terms of cap-weighted or equal-weighted, don't have a dog in the fight of which you think is better. Each of them are going to be better at certain points in the cycle. Just try to focus on where that relative strength is being treated. In terms of a really interesting fact that goes on the cap-weighted, at least I thought it was interesting, I want to put up a chart right now. In the S&P 500 performance year to date, and let's call that 15% today. So we're at about 3 p.m. on Friday, market up 15%. Take a look at this chart. Nvidia, which we know is a monster, is responsible for over 30% of that return. Now, I tried to go back and look for some historical precedents of a 6-month period, year to date, January through June, where we had a similar move, where one equity was responsible for over 30% of the positive or negative performance in the S&P. I couldn't find it, but maybe somebody can help me out with that. The reason I mention this is look at some of the names to the right that have not performed this year. Names like Visa, MasterCard, Home Depot. Very little performance out of those areas. Visa and MasterCard are going to be large recipients of AI in terms of driving margin to their business. Yet they've been on the outside looking in year to date. Be interesting to see if some of the money starts to flow out of Nvidia or even Microsoft and spread itself a bit, because that extreme doesn't tend to continue. And we do know if money starts to pull out of that area, specifically Nvidia, it's become such a dominant part of the indexes that those indices are going to have trouble sticking in there. You're probably going to have some pullback. Now, is it just going to be a pause that refreshes, or the indexes take a breath, or do we get some damage? Don't know yet. One thing is certain, in owning hot, high-flying names, and it can be Apple, it can be Microsoft over the years, it can be Amazon, we have to be able to accept the fact that there will be, not maybe, there will be 10 and 20 and 30% drawdowns. I've owned Apple for years, as have clients. They remember having entered it in 2005 and 6, 30 and 40% drawdowns in 08 and 09. Yet, here we are in 2024 with a significant move. A cost back in 05 of $3 a share. Apple up through $200 a share today. So just be aware and position your stocks properly. If you're getting too overweight in one holding, volatility can emotionally knock you out of that name. Position sizing is as important, if not more important, than where you enter and where you exit a trade. So, just some thoughts that we're looking at. I would love to see a little continuation in that equal weight bid, just in terms of having more allocation working. Now let's shoot over to the Moose, who's taping remotely this week.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday morning on June 21st. This is the bond report for the week. Yields up a smidge. 10-year bond is a 426, up 4 basis points. 2-year bond in Treasuries at a 474, also up 4 basis points. Crept up just today. The whole yield curve is unchanged till this morning, when a little bit stronger than expected. S&P Purchasing Managers Index came in a little stronger than expected, so yield snuck up a touch. The rest of the week was pretty much flat, mainly because we had a holiday week, of course, with Juneteenth on Wednesday. But when you start to look at things like retail sales, down more than expected, initial jobless claims, higher than expected, housing starts, lower than expected, building permits, lower than expected. So the narrative this week has been pretty much taking a step back. And that's, of course, been the narrative over the last few weeks as things have cooled off a little bit. Remember, the 10-year bond yield just less than a couple of months ago was at a 470. So that's been pretty good progress coming down. Muni yields this week actually flat to maybe down a touch. We haven't seen the yield changes for the week on Friday today, but for the week so far, they were down 3 or 4 ticks. Solid demand for municipal bonds. We expect that demand to keep up, particularly as we get closer and roll over to the July 1st period, where there's going to be billions of dollars rolling over in maturing bonds, called bonds, coupon payments. That'll be a pretty big source of demand as you head into the beginning of July. And if it's like usual, things then taper off a little bit, and some of that fluff goes away. But the next week, very little in terms of data next week. We will be looking at the personal consumption expenditures. As we know, that is the Fed's favorite measure of inflation because it captures some of the differences in consumer choices. It is not a fixed basket like the CPI data is. So we'll be watching that for next week. We hope everybody has a great week, and we'll see you next Friday. Thanks a lot.
Thanks, John. I mentioned position sizing earlier. It's a topic that traders and investors struggle with. If that's the case within your own portfolio, feel free to reach out. Let's discuss it. See you next week.